Market correction continues for the markets after Cyber Monday. What that means to your money coming right up. On Friday, the markets declined sharply for a half day of trading as the Omicron variant really made its first appearance, spooking the markets. On Monday, the market rallied back, not surprisingly, after that big sell-off. The interesting point here, though, is that the rally yesterday, which was a full day of trading, had about half the volume of what we saw on half-day trading on Friday's sell-off. This morning, markets are pointing lower as concerns about the Omicron variant exist. But again, this really all falls in line with what we've talked about over the last couple of weeks. Over the last 2 weeks, we talked about the market consolidating this recent advance and that we would likely see a bit of a correction during the first week or two of December. It's happening a little bit sooner, but not by much, as mutual funds are going through their annual distributions. That's happening now. And of course, what the market needs is a reason for this correction. Of course, they're pointing to the Omicron variant for that, but the markets were already due for a correction. We had weak breadth, weak internals of the markets. We had an overbought condition in the market, and we had sell signals on both our money flow as well as our MACD. It took a little bit of time before the markets began that correctional process, but we're in the midst of that now. Here's the good news. First of all, the markets are still working through this consolidation process after breaking support in the markets yesterday. The good news is that our money flow indicator is now beginning to flatten out and bottom. That's the first kind of initial good sign that we may be getting through this correction process here over the next week. The MACD still turning here lower, and that sell signal still very much in place. So again, we don't want to dismiss that signal at the moment, but with our money flow indicator bottoming here, that does suggest that over the next few days, we could see a bit more volatility. The market should start finding some support between recent lows and the 50-day moving average. So again, there's not a lot of downside risk from here, but there is some. Now, as we continue to go through this mutual fund distribution process, all that suggests is that there could be enough buyers to help absorb some of those distributions. But again, we're likely to see a bit more of this weakness in the markets near term. That will set the markets up for that year-end rally, that Santa Claus Rally that we've been talking about, and that movement to the first phase of the first week of January. So the important thing here is to start making your watch list for the stocks that you want to own heading into the end of the year. Focus on some fundamentals here, because moving into next year, it's very likely that fundamentals will play a much more important role in a year where we may see an increase in volatility in markets across the board. So again, look for that opportunity to begin increasing equity exposure. Look for that rally into the end of the year. And then as we get into 2022, things will start to change. We'll be watching global inflows, the Fed monetary policy, and of course, fundamentals on markets. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.